The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service, Become a Pro course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
Hello, good evening, and welcome to the Become a Pro course here at Forex.Academy, presented to you here by your host, of course, Robert Blackwell. Now, just before we continue, please have a look at the following disclaimer. There is risk inherent when trading these financial markets. And of course, as always, just a few pieces of housekeeping before we begin the lesson. So of course, it is an interactive webinar as we go through from webinar 1 the whole way through to webinar 16 of the Become a Pro course. You make use of the interactive webinar. Feel free to ask questions there with the chat box located on the right hand side of your screen. Of course, you can ask questions throughout the webinar, or if you prefer to keep your questions to the end, I'll be able to address your questions towards the end as well. The live webinar is being recorded and will be placed into your members area once the webinar has concluded. So if you could just give us a 1 hour grace period so that we can process the video and upload it for revision purposes into your members login area. And of course, as always, we'll have a Q&A session at the end of the live webinar so we can deal with any questions as we go through each individual lesson. We'll take some time just to refresh and do some study just over the course. So the Become a Pro course, really, what's it all about? Let's go through the course overview, and that will be particularly the full context of today's lesson. It is, of course, in very high detail, this course, where we aim to take those fully fledged retail traders and move them on to the next step to actually develop them onto developing professional trading strategy. So the course overview will take the approach of today's lesson, and then we'll discuss the approach to professional trading while moving on to effective market analysis. So there are different types of traders in the markets. Some prefer fundamental trading, some prefer technical analysis, some obviously prefer a hybrid of both. So that is a question for each individual trader to really discover. As you get more experience in the markets, you may have a preference for one or the other. Then, of course, we'll go on to the understanding of the macroeconomy, and that leads us to really developing, forces of supply and demand, how these markets move in terms of their price structure in accordance to the buyers and sellers, and how prices are dictated. Then, on a more economical scale, we'll move into a sector analysis, capital trade flows. We'll be looking at the economic data to see how that affects markets, both in the medium, short, and long term. We'll be then jumping on to technical analysis, which will take the construct of quite a few lessons, not only discussing components of technical trading, but really building our own ideas about technical trading strategy and finding out, what works best for you as a technical trader, what you're more susceptible or you find to be the most, forcible strategy that you may like to implement. Then we'll discuss currency trading and really the fundamental focus behind Forex pairs. Obviously, we know they're focused on strength and weakness, but there is a lot of context to the Forex pairs that will give you a real competitive edge over Forex trading. We'll then look at market correlations, both in the Forex markets and, of course, deliberating over different asset classes. We'll discuss risk and risk aversion as well. So this all feeds into the factor of protecting your capital, knowing when to actually take trades as well as to avoid them, and what sort of risk you should associate a particular trade idea with. And then we'll look to actually diversify those risks through what's known as portfolio diversification. So, we have the trading platform there now with the birth of, I suppose, financial derivatives such as the CFD. We can actually trade a wide range of asset classes. So there are natural ways to mitigate risks through holding medium terms with a selection of different markets that allow you to spread risk across asset allocation. And then we'll be finishing off the lesson there with lesson 16, the course with lesson 16, developing trading strategy, and that's when we start to combine what we've learned, whether it's the real economical discussions of fundamental analysis or a preferred strategy towards your technical techniques. We'll start to develop our own personal trading strategies towards the end of the course. So what is the aim of this course, the Become a Pro course? Of course, it's really to focus on yourself as a trader. You know that at this stage we are taking this seriously as much more than a trivial pursuit. We're looking to profit in the markets over the long term. Well, the Become a Pro course focuses on the study of the financial markets and the macro environment. Okay, so there is, these markets operate and they move according to what's happening in the global economy. They don't simply move because some new buyers come into the market and decide to push the market one way or another, or adversely sellers come into the market and simply push the market to the downside. There is a reason for this, of course, and there's much more of a reason across asset classes like commodities, how they move like they do, equity markets, how they move in terms of an association of risk. And we need to obviously gain a real understanding to effectively analyze these markets with consistent results on our mind. With an in-depth understanding of financial markets in the full context of the economy, both complex, fundamental and technical analysis is discussed with the sole aim of developing a personalized professional trading methodology. So that is hopefully the aim of each individual student on our Become a Pro course here. We are looking to move forward, to take a step forward, to actually aim to develop a consistent trading strategy so that we can apply it, so that we can actually apply it to all these asset classes to trade profitably over the long run. So the course then is designed to turn what we would call avid retail traders, fully insightful retail traders, into fully fledged experts in trading the financial markets by building on the early technical principles. The theoretical study of the macroeconomy is then subjected to analysis so as to derive a complete and comprehensive understanding of business operations and how asset prices move as a result. And that is where we focus our expertise in obviously trying to forecast future price movement, whether we have a real deep understanding of the market in question that we prefer to trade. We have hopefully developed a trading edge within these markets. So this is the course timetable, and I can just discuss this in light-hearted detail as we enter Become a Pro course webinar 1. We have the course over the next month ahead, so over the next 4 weeks, with one lesson at the same time each Monday, Tuesday, and Wednesday and Thursday. So this is the first lesson. I'd like to take this opportunity to welcome everyone on board, and hopefully we'll enjoy this experience together throughout the course of the month. So moving on then to our course overview, we will begin today with a Become a Pro overview. So the context of this course is really to give you a basis of what you're going to look forward to over the next month, to really build out a structure for you so that over the next 4 weeks you can sit down, you know exactly what you're going to be studying, you know how it's going to relate both as a student of the markets, not just only in terms of trading the markets, but in terms of the insight into the economy and your relation to pricing certain asset classes. So that will start with today's lesson. Moving forward to discuss the 4 lessons this week, we have an approach to professional trading. And it is very important to define at this stage, now that we have, and I would assume a lot of the retail traders have got some experience under their belt, of course, before delving into this Become a Pro advanced lesson. It is very important to assess, what style of trader you are, what your expectations are, and what your approach is going to be over the long run. So that's what we'll deal with in terms of defining a professional trading approach. There are certain principles we all follow here, disciples of the market over the past 15 years, different practices we like to follow, and how we look to actually use the knowledge to properly disseminate the information that is available. Effective market analysis, then we'll take the main structure of lesson number 3 there. We'll look at the different methods of analysis, the objectives of financial analysts as well. They have a completely different objective to actually looking to simply speculate and make money, but we can take a few lessons from their book. Knowing your market and understanding the context of your market you're trading in, and then decision making, of course, very important indeed in terms of underpinning the type of analyst you would like to be. And then Webinar 4 will discuss the macroeconomic environment. It's quite a heavy lesson in terms of the theory involved, but my hope is obviously that we start to embrace the theory of macroeconomic activity, because it will serve you in terms of understanding every single economic data figure that will come out and how it relates to inflation, perhaps how that inflation relates to interest rates, perhaps how the interest rate will relate to the currency you're trading. Everything is intrinsically linked, and that's where we'll start to develop on that theory. Then we'll obviously finish off then with the business cycle and trading economic development. So we'll look to see how these certain forecasts and news flows enter the markets and how market participants begin to react as a result. So let's deal with some of these issues straight from the get-go. Why, I suppose the main question I would like to ask, just hypothetically, totally hypothetically, is why do we trade the financial markets? So why do we trade the financial markets? And it may come across a little obvious to ask such a question, but there are more reasons why certain market participants look to enter the markets, and in actually understanding that will help us over the long run. One is to search for a better rate of return on capital. Now, that doesn't mean simply to make 300 euros per day or a fixed amount. It may be because you need to understand it within the context of the investment community. So one example I'll pick here is in relation to global bank interest rates. So I suppose, the financial crisis, we had interest rates there. I do remember receiving an interest rate from the capital I had in my bank account. And obviously, because of the level of recovery and the changes made on a monetary policy level, those have affected us gravely. So all of us who have deposit accounts there across Europe effectively aren't seeing much interest rate in leaving the money in a bank. So something like financial trading is, of course, appealing, given I suppose, how lucrative the environment is and can be. But we need to obviously search for a better return and understand how to trade and beat the market in relation to return. To trade asset classes that were once restricted to Wall Street. So that's a very primitive, but albeit a well-deserved example. So, more and more of these asset classes are becoming available. 20 years ago, we perhaps could not trade the price of oil. It was restricted for some of those hedge funds or top financial institutions on Wall Street. Now, of course, each and every one of us have the opportunity to do that. And now we're seeing more asset classes being added to the table, such as cryptocurrencies. These guys are allowing us real speculation. They're allowing us opportunity for that return if we trade properly. So that's, to me, that's very exciting, the ability to look for these profit opportunities in the markets. To profit from price swings in financial markets is, of course, a main objective, and more, I suppose, more, something that happens each and every day. More commonly, I suppose, where if we look across the equity markets or forex markets, they're moving all the time, and there are large institutions getting in and out of these markets, making large sums of money. But that's available to us as these assets simply move, and from high to low, we can get involved in these price swings for smaller profits as well. So there's many different ways to make money in terms of defining your own opportunity and to invest in value opportunities that deliver long-term income. Okay, so the investment community, again, it's not only relative to Wall Street or high net wealth individuals, it's relative to all of us. Some of us perhaps like to keep our money in property and rent houses if we have available disposable income. Others look towards the equity markets to invest in value opportunities, perhaps a company in your local area that's performing well, or perhaps on the global markets. If you if you see value in something like Google or Microsoft or Deutsche Telekom or Tesco's, any of these companies are fully available to us as investors to look for many different ways to not only profit from their price, but to look for value in investing. So it's very important, when we go through these lessons, we aim to deliver an approach to professional trading that is very much succinct to how professionals do it. Now, we all have different associations of risk. That's not to say we should all trade similar, but we should all develop a keen approach to take this seriously, to look into to teach ourselves the necessities to stay alive within these markets and to deliver return on a consistent basis. So you must dedicate time and education to learning. And that's fantastic that you guys are on this course of call, because that is certainly the case. You must accept winning and losing is part of the job. Okay, it's part of our job as financial traders. There will be one day that will be very, very hard to take in, because you'll potentially lose a lot of money. But you need to control that. That is part of the game. There will be other days where you will, of course, outperform. And again, you just take that with a pinch of salt. You must give yourself the time and focus to develop discipline. And that is certainly what it needs. Discipline is not something you can learn overnight. As you start to deliver consistent returns and very easily take more and more losers, you'll see that your discipline is simply a factor of your trading. You must make consistency a top priority, as your personal objective aims to create a long and fruitful trading career. Again, so it's not necessarily our objective to enter the markets for 1 year and make a lot of money and leave high and dry. That would be great, of course, but that's much more difficult to do. What we can do is take it seriously, focus on a professional approach, hopefully look to trade the markets for 5, 10, 15 years, developing personal income each and every month, because it's certainly available to us. So effective market analysis will, of course, be the construct then of lesson 3. And really, we define it as financial traders in 3 schools of thought. So we have fundamental analysis. It is the examination of the underlying forces that affect the well-being of an economy, industry group, or company. As with most analysis, the goal is to derive a forecast and profit from future price movements. That's certainly the case. So fundamental analysis, it's much more involved. There's much more research in it, but it can be very fruitful indeed. Technical analysis is simply a methodology for forecasting the direction of prices through the study of past market data, primarily price and volume. So that is something that most of us are very, very interested in, because, well, it's very difficult to develop fundamental research or strong fundamental knowledge on every single market that you want to trade. It will take a lot of time. Perhaps some of that information isn't available to you. Perhaps you don't know how to properly disseminate that information. So technical analysis, if we believe all information available is embodied in the price structures of these candlesticks and movements, then we can simply look to trade and speculate and teach yourself the skills available to do so. And then finally, sentimental analysis. It focuses on identifying and measuring the overall psychological state of all participants in the market. It attempts to quantify exactly what percentage of market participants are bullish or bearish, which basically buyers and sellers interacting in the market, shifting the market one way or another. So we can look to choose, as a personal preference. It doesn't conflict with our own approach in terms of a professional approach and how serious we take it. However, the skills necessary, it's a plethora of these 3 here, where some traders are essentially better at fundamental analysis and like to use some technicalities, or vice versa, and include some sentimental analysis as well. So that's a pursuit in itself for you over the next month, to answer that question, to which you prefer and how you'd like to trade. So it is at times difficult for traders to decide what side of trading they are better suited to. Yeah, it's absolutely true, absolutely the case. The truth is that most professional traders expand their knowledge so that they are able to develop a hybrid approach to developing trading strategy, one that involves all 3, so fundamental, technical, and sentimental analysis. And that is certainly the case. Even on lesson 1 here of the Become a Pro course, many of our students may believe, well, I think I have a knack for technical analysis, and I have a preference to actually pursue that. But as you go through this course, you will understand more about the economy and how potential markets move in relation to economic moves within the environment. And that knowledge, or that increase in knowledge, will expand your capabilities on a fundamental side, whether you believe it will or not, of course. So do take everything on board. It will always serve to heighten your knowledge and expertise within these markets. So then the next focus lesson will, of course, be delving into understanding the macroeconomy. And this is really the larger economy. So we define the economies, if it's a domestic economy, what is happening within that economy, as microeconomy. If it's an overall economy, perhaps of one nation or of the Eurozone, we will refer to that as the macro economy. So what's happening in the overall economic environment. So here we have the business cycle again as an example. We have GDP, or gross domestic product, there on the left. We can see the business cycle has many different points of reflection where it obviously factors into how risk is associated with all of these financial assets and markets that we trade. And we need to understand exactly where we are in terms of sentiment and positioning with the business cycle in terms of how those markets refer to the current status quo. Okay, so that's very important. Of course, now we're in a very bullish, strong period. So we see risk on is the theme. That means you have a higher probability of trading riskier assets over the long run, of course, but trying to also look for value in between. So it's very important to note, and we'll discuss it in a lot of detail throughout the macroeconomic lessons. So key questions that we'd like to focus on. Again, I'm trying to get, even from lesson 1, guys, the focus is to think like a trader. So I want you guys to think as we go through all of these lessons like a financial trader already. You're not only looking to make some pips in a particular market, you're looking to understand why these markets are moving, why the macro economy is reflecting perhaps an equity market within your local country or your local nation. So start to ask these questions for yourself. What is the current state of the global economy? Okay, so let's say we're about to take a long-term position in the Euro Stoxx 50 there, okay, which is an equity index consisting of many different equities over Europe there, mostly in Germany, France, Switzerland. We have some in the UK as well, and many other firms in some countries. So we're going to take a long trade, perhaps in one of these equity indices, the Euro Stoxx. What is the current state of the global economy? What is the current state of the local economy of that particular firm? What are the current uncertainties overshadowing local asset classes? So what are the risks involved locally of trading this asset? And what is the best trading opportunity in this environment? So have I chosen, what I think after doing some macroeconomic analysis, is this market that I prefer to trade now? This, perhaps I'm looking to buy some stock of a company there. Is it the best trade? Is it the best trade after doing my analysis? If that's not the case, I may see something much cheaper if it's an equity investment, or if I'm excuse me, if I'm a technical trader, it may be at a better inflection point, or provide a better technical setup. So very important questions to ask. So let's think about how some of these news flows or economic data will look to affect the macroeconomic level of a country here. So here we have Germany to choose one example. The German ZEW, which is an economic figure of confidence there. We have German industrial production. So what does that mean when it becomes, I suppose, supportive of some of the largest firms that produce and contribute to German GDP? Inflation within Germany. What is the current inflation, and what is the central bank going to do in terms of the expectations on rising inflation? And also then, what if the German CPI figure is released to the market and it actually comes out much less than expected? How does the market react to that? How do the forex markets react? How do the bond markets, particularly in Germany there, the European leader within the bond or debt markets, how do these markets react? ECB press conference, obviously we have Mario Draghi there as the president. How does his rhetoric move asset classes? And of course they do. Every time he speaks, there's a large amount of increased volatility across European asset classes. German unemployment, of course, a very intrinsic one. And German politics. How do shifts in German politics affect potential assets that you'd like to trade across Germany, or perhaps the German equity indices as well? So the truth is that there's no right or wrong answer. But again, I want everyone to start to really reel in and start to think like a trader, and know and understand that evidently all of these things are intrinsically linked when we look to trade the markets. So here we have yet again another example of a flow, a potential flow of income or money throughout different decisions, throughout different asset classes, through different market participants. So let's follow some examples here to understanding the macroeconomy. Well, we have a central bank, of course. It creates money, so it's increasing the money supply. It's to buy bonds from financial institutions, so perhaps it's actually increasing the money supply through purchasing financial bonds there from institutions. So effectively swapping bad debt with good debt. So that's creating, I suppose, healthier financial institutions within our systemic system. And then obviously this will reduce interest rates as these bonds are as price, there's more demand for the bonds, so there's more of a demand for a higher rate of return, which actually will reprice into the market, reducing interest rates. Leading businesses and people then borrow more because there's a shift in interest rates. They boost spending and create jobs then as a result. And there's a hope then that there's a sort of growth in the economy. So we're seeing effective quantitative easing here within this economy, and it's all cyclical. So you can see how these market participants are looking to really get involved in following this movement of one, I suppose, macroeconomic shift within the domestic economy.